U.S. dollar is the kingpin in the global economy, and its continuing devaluation is destined to impact the rest of the world. If that devaluation is sudden, I suspect many people will be blindsided and panic. It could happen at any time with the right trigger. It could happen on any ordinary day on Wall Street, even a day like today. The Dow, NASDAQ, and S&P 500 are all up. Gold and silver are at all-time highs, and U.S. unemployment is officially at 11%. The U.S. dollar is in decline. The Federal Reserve prepares to do its quantitative easing trick at the Wednesday bond auction, pushing the dollar down even more. China announces they won't buy more U.S. notes until the U.S. stops devaluing its currency. The news hits the wire, and a nervous Wall Street shudders. Over the weekend, the president holds private meetings with the Federal Reserve and G20 leaders. On Sunday, the Asian markets open and go into instant meltdown in response to China's rejection of U.S. bonds. The Asian markets quickly drop 5%, then 6%, then 7%, then slip into free fall. Other currencies start to slip, and soon an avalanche of sell orders sends markets around the world spiraling down. A few hours later, Monday's opening bell at the New York Stock Exchange triggers mayhem. People dump stocks and sink everything into precious metals and commodities. In minutes, gold jumps 300 an ounce, then 400 an ounce. Silver quadruples. Everyone wants to sell, but no one has any liquidity except China and the Middle East. European countries raise interest rates by 3 or 4% to attract buyers, but there are few takers. Unprecedented competition for the remaining global liquidity forces volatile markets down even further. A half hour after the New York Stock Exchange opens, its computer circuits pop under a deluge of sell orders. Wall Street computers freeze, and trading is halted for the entire day. Tuesday morning still sees circuits jammed with sell orders, and the New York Stock Exchange is unable to open. With no buyers, the market is dead. The Federal Reserve announces a hike in U.S. interest rates to attract bond buyers and generate liquidity. Global markets don't like the hike, but stabilize somewhat, although they are still down 6 to 7% from Friday's close. Just 2 hours after the Fed's rate hike, buyers return, and the NYSE is able to open. Throughout the week, global markets take a beating before they find new support levels. But in spite of the U.S. interest rate hike, global confidence in the U.S. dollar continues to erode. Gold and silver continue to rise. Palladium hits a high. Global currencies keep falling. By the close of Friday, traders around the world are walking on eggshells and having a hard time sleeping. That weekend, the Fed meets again with the president, then announces a second interest rate hike. Currency markets instantly respond. Banks in Western Europe hike interest rates in sync with the United States. On Sunday, China has first crack at the higher yield U.S. bonds, but buyers are still scarce. By now, the public is definitely aware that something is wrong. Desperate people begin to panic, and there are a lot of desperate people. On Monday, the opening bell at the NYSE triggers a glimpse of hell. Traders around the world become net sellers of equities, bonds, and Western currencies. Everyone wants out at the same time. Panic and confusion sweep the globe, and markets are in free fall again. This time, nothing stops them. Within minutes, electronic trading systems around the world short-circuit under the load of sell orders. The NYSE shudders to a halt in what will become known as the Great Wall Street Freeze. As billions of dollars in wealth vaporize,